I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the first thing you need to know. The state of the consumer here. Walmart topped expectations in its fiscal third quarter, but the retailer's guidance was lighter than Wall Street expectations. The company's CFO saying on the earnings call that guidance reflects a cautious outlook on the macro environment and that consumers will probably continue to shop for lower priced goods that could pressure its margins. Walmart is known for its budget-friendly prices, but analysts will be watching to see if it's able to keep its prices low enough to spur demand. The second thing you need to know, Home Depot's revenue falls short. The retail giant saw its first revenue miss since 2019, a sign that the home improvement boom we saw during COVID-19 is finally waning. The company also posted a surprise drop in same-store sales for the quarter, and that's not all. Home Depot also posted a muted outlook for the coming quarters thanks to a tougher consumer backdrop and uncertainty in the housing market. And the third thing you need to know, we're on Geopolitical Watch this morning. Russian President Vladimir Putin gave his first State of the Nation speech in almost 2 years. It was a defiant speech where he vowed that Moscow would continue its fight on Ukraine and double down on his stance that the West started the war, not Russia. His speech came just a day after President Biden made a discreet visit to Ukraine to meet with the President Volodymyr Zelensky of Ukraine, where he promised more support to help take on Russian forces. Well, let's get back to thing number one here of the day and check in on the health of the consumer. Walmart is out with its latest earnings, and the retail giant posted a disappointing profit outlook, signaling a rocky year ahead after a strong holiday quarter here. We've been tracking shares of WMT here pre-market, and they have been lower. There's two things that jump out to me as you saw me even coming down here for the show. I was still listening into this earnings call just to get some nuggets of information for our viewers here that isn't directly called out within this earnings release. And there's two things that stuck out to me. One of them, you're going to continue to see persistent pressure on product mix shifts. So some of those areas of weakness that they talked about on the call were toys, electronics, home, and apparel. That could persist in the near term, depending upon where the consumers continue to place their priority in their purchase patterns right now. And then additionally, this is going to impact their sales growth. They're forecasting and anticipating sales growth at a lower rate here today. I think analysts paying close attention to that throughout this morning's report and some of what the company's chief executives are saying right now.
Yeah, this decline in earnings, for projected decline in earnings this year, will be the second straight year that Walmart has seen a decline in earnings. And all of this is sort of the legacy feed through of the company relying too heavily and ordering too much of what's called general merchandise, the non-grocery stuff. People not ordering it last year. Walmart, just refreshing you guys' memories, having to cut its forecast, right, a couple of times to sort of catch up with all of those adjustments, and now figuring out where people go from here. The head of the U.S. unit at Walmart on the call saying that consumers are more choiceful right now.
Oh, yeah.
I guess that's a new word, choiceful. We're all being more choiceful in our in our grocery shopping and elsewhere, in our shopping generally, in our purchasing decisions. We are all being more choiceful in this environment.
When I'm being choiceful, I am saying no to a lot of things.
Yes, exactly. I'm saying I'm going to take this cheaper item.
Yes.
Maybe this private label item, this store brand item, instead of this brand name item. So that seems to be part of what's going on. One of the reasons perhaps that we're not seeing the stock down quite as much as it was earlier, there were a lot of questions because of this decline, this forecast that's disappointing, about Walmart was still sticking to its long-term sales growth target of 4%. A UBS analyst on the call asked them about that, and they said yes.
Yeah.
Pretty simply, unequivocally, yes. So that might be sort of reassuring to investors.
There's some other interesting tidbits that came up on the call. This is a company that now has 400 million SKUs on its website. So that is a ton, to an exponential extent, of items that they've got in inventory that are listed. And it's not all, of course, all items that Walmart has in inventory. They are really drumming up this e-commerce platform to be just that, and a place where not only some of the third-party sellers can come to list their products, but that advertisers can come as well and see higher conversion rates on some of their products. And that dovetails into a fast-growing part of their business that actually could accelerate some of the margins going forward in this advertising business. But the e-commerce business right now is about an $80 billion business that Walmart has. So one kind of feeding the other major goal and initiative to really prop up some of those margins, even in the face of some of that deceleration on the sales growth itself.
Yeah, and one quick final note on that front. In its fiscal fourth quarter, average ticket was up 6.3%. Transactions were up 1.8%. So even though Walmart is keeping the value proposition for its customers, it is still raising prices, right? It's just not raising them so much, it seems, as to scare people off, at least not at this point. Well, Home Depot's revenue missed expectations for the fourth quarter as the home improvement giant reported mixed earnings, also issued as well some weak guidance for the fiscal year, as Home Depot expects sales growth to be approximately flat compared to fiscal 2022. Those shares are down by about 4%. The key thing coming out of Home Depot here is an increase in pay for its associates. The company is now saying that it's going to have $1 billion in additional annual compensation for frontline hourly associates this year. That's going to squeeze its margin this year to about 14.5%. So really interesting here that at the same time that the company is looking for sales growth to slow, it's paying its people more. So that's a tricky combo.
Paying its people more and paying its investors more too. They increased the dividend by about 10%. That's something also similarly within this kind of retail story here on the morning that you heard from Walmart. And it seems that the dividend, locking that in for investors, for Home Depot, at least right now, might be a way to just continue to try and maintain some of that confidence, even if you do see some of the waning demand, whether that be derivative of what they're seeing in the housing market right now or the number of people that are just taking on some of these DIY projects. Perhaps as of this point in time for Home Depot, really making sure that the frontline associate $1 billion in annualized compensation increase and investment that they're mentioning, plus the investment in the investors in the form of that dividend increase. We should note, a dividend increase does not necessarily signal a healthy company all of the time. However, it does signal that there is some balance sheet strength that they can deploy even when times look a little bit more murky. So perhaps that's what they're trying to tap into.
Well, and also sometimes it's a message to investors, right? It's saying, this is the investment we're making right now. We know times are a little bit tough. Here's a little something extra to stick around. And so that seems to be at least partially the case. We do want to mention, as we talk about Home Depot, two other things.
Retailers that have been able to scale up, the ones that we've been tracking this morning, Walmart and of course the likes of Home Depot, that's meant that they have a larger employee headcount. That means that they have larger square footage that they operate. But for investors looking at how these companies would also weather a recession, which some have said is the most telegraphed recession in history perhaps, when we hear the company allude to what that recession may look like, should investors still be more confident in the larger scaled up operations relative to the rest of retail?
I would tell you it's probably the most bullish I've been on retail because, of course, retailers sell products. But what we're starting to see now, going back to this kind of bottom line, is they're also now monetizing their data. They are they've got the whole kind of retail media play. And as you referenced earlier in the show, right, this kind of idea that they're building these platforms now for e-commerce, and that allows them to sell all kinds of things, goods and services. So yes, their core business, I think, will be challenged in 23. There's no doubt about that. And whether it's, kind of paying associates more, dealing with inflation and, let's just call it a volatile macro environment. But there are all these additional, and much of these kind of opportunities to monetize didn't exist a year ago. And that, I think, is something, those are kind of really what to listen for this earnings season is what are the additional opportunities to drive revenues. I mean, we're hearing, right, Sam's Club is opening 30 stores over the next few years. They haven't talked about store growth in years. So there is this idea of really gaining market share right now. And I think that may be what you're focusing on is you are going to see these large multi-brand retailers continue to focus on the market share gains because they need the eyeballs to monetize. And that is a new game for them that they haven't played before. And they're finding, I would say, additional opportunities to do that, ways to do that. A lot of that is technology driven, but also just creativity. And we believe that we will see one of the best years when it comes to the bottom line for retailers in 23.
And analysis and research and insights. Thanks so much for taking the time here this morning. Deborah Weinswig, Coresight Research founder and CEO. We appreciate it.
Thanks so much. Bye-bye.
Absolutely. And the second major thing, or one of the other major things that we are watching this morning, geopolitical tensions escalating after Russian President Vladimir Putin has reiterated his stance that Ukraine and the West started the war between the two countries. These comments come after U.S. President Joe Biden made a surprise visit to Kiev yesterday, nearly a year after Russia invaded Ukraine. We'll dive deeper into the geopolitical divide with AGF Investments Chief U.S. Policy Strategist Greg Valliere later on this hour. Key nuggets within the morning brief this morning. One big thing that did jump out to me from the brief was this fact that Brian had added in here about the Federal Reserve and how they have embarked on inflation and cresting rate hiking cycle 9 times since 1961. 8 times out of that 9, a recession has followed.
I mean, you always fight the last war, right?
Yeah.
So that's true of the Fed as it is of most of us, right?
Yeah.
Is that you are drawing from your experience. And of course, the Fed doesn't want to make the same mistakes again. No. That doesn't mean they're not going to.
It's tough.
Yeah, it is.
I don't want that job. Guys, for more on the Recession Watch talk, everything Fed speak, we welcome in Tom Essay, who is the Sevens Report research founder and president. Great to have you here with us this morning. Take us into what your thesis around, and yeah, we're taking, I guess, no landing off the table and what that would mean this morning. But in terms of what we expect to hear from some of the FOMC meeting minutes once they do come out, and comparing that with the Fed speak that emerged last week, how would the markets continue to really price in what this means for the future of Fed policy pathway?
Good morning, and thank you very much for having me. I think that throughout the past 14 months, really since the start of 2022, we've seen a very consistent pattern where the market takes some data that is sort of favorable towards the Fed easing off rate hikes, and then extrapolates it out to be a looming change in policy. And we came up with buzzwords like pivot last year, and then late last year and early this year, it was the Fed pause, not a pivot, but a pause. And now we've sort of continued along this trend. And each time the Fed sort of gives the market a smack, a proverbial smack, and says, no, we're not done yet. And it's kind of happening again, isn't it? And that's why stocks are down over the past 2 weeks. I think the minutes will continue that trend. The simple answer is that growth is still too strong for the Fed to really ease off. So stocks can hold in as long as they don't really ratchet up rate expectations beyond much of what they think now. But if we get another 50 or 75 basis points of tightening, I doubt the S&P 500 can hold 4,000.
And so, as we're going to be watching closely to see how every part of the economy also braces itself, I mean, because it seems like we've been bracing ourselves for some type of impact for, the past 9 months at this point in time. Where does this really start to show up in some of the data, and has it already shown up in some of the data in terms of the impact of the Fed's policy and early signs of what we could deem early signs of a recession?
Yeah, I think the consumer spending data is really the key, right? Because we're going to see a sort of a gradual decline. Employment is the focus, right? Because the Fed's made it the focus. But it's the biggest lagging indicator we have. And I mean, just think about this like practically, right? If you're hiring people, or I'm sorry, if you employ people, the last thing you do is fire them, right? And you only do that after a business is already turned down. You don't preemptively fire people on the idea that things might go down and then all of a sudden find yourself in a lurch when they don't, right? Watch the consumer spending data. It's not going to fall off a cliff. People have done too well the last couple of years for it to fall off a cliff, but it will begin to decline, and that decline will accelerate. Employment comes next, maybe in the middle of the year.
So, Tom, put it all together for us from a strategy point of view. What should investors be doing right now?
So I think that generally speaking, investors shouldn't be running away from stocks or bonds because a recession is not a foregone conclusion. I and everybody else that's worried about this could be wrong. It could be different this time. But I think that in those equity and bond allocations, you must put the safety, consistency of cash flows first. Do not reach out on the risk curve. Do not go overweight very aggressively. I think the penalty for being too aggressive right now is much higher than the reward for being too aggressive right now.
Well put. Caution right now. Thanks so much, Tom. Good to catch up with you. Sevens Report research founder and president Tom Essay. Appreciate it.
Thank you.
Coming up, shares of DocuSign are sinking after getting hit with a downgrade from UBS. We'll discuss. Plus, we've got the opening bell on Wall Street coming your way. Plus, sneakerheads, stay tuned for a duo of great conversations with the CEOs of New Balance and Brooks in the next hour. Suit up, put on your shoes, get ready for it.
Lace them up.